Welcome, it's the Crypto Sniper coming at you. Yes, on this Friday, what's going to happen? What's going to happen with crypto? Well, first of all, what's the message that we're giving you? The message is the following. There is signs of real recovery for crypto, fatigue in the bear. However, there's a massive but, and this extends to the macro. First, let's have a look at Bitcoin. Here we go to the charts above. So this is overall our first cup gold nugget. That would have been your idealized target take from this big macro draw. Let's bring in our pen as usual and re-highlight you. So small revision of recent history. It helps us to get flow and identify which direction we are going. So the big macro, there you go, pop, 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 and then targeting out, head and shoulder, falling wedge. And then we have this larger blue head and shoulder. We will come back to that because it's a as yet unactualized potential downside target. Targets are not things that are contracts that are written in blood and signed and sealed by monarchy. They can be performed to, or if not performed to, they are feedback events on the bearishness now abating. We like to have time frames associated with targets so that you aren't just sitting there holding on to an end of a thread or an end of a stick forever and infinity, waiting for something to happen when new events have come and market is moving in a new direction. So there is a bear out there that is still at in around the 1514. We'll talk about the but. There's signs of potential recovery, but why the but? And the macro element in a bit. We also have the flagging that's gone on. That flag target was made, but this larger one is also outstanding in and around 12k. Now again, that's not a call. We aren't saying it's going to 12k. We're saying there are things that suggest that that possibility is on. That doesn't mean it does it, because you have a funnel all the way back down here at 10. This would be fairly strong support, we would imagine, and there's quite a distance between the 12k and the beginning of 10 of $2,000, and that's of course 20%. We've also seen lowering volatility and then a squeeze to the upside and reduced down sells. So there's down sell, down sell. We ended up having a capitulation. These are the lows, absolute extreme lows. So these were two very brutal lows that dipped harshly. And then the final low here for this period is actually what we call a marginally lower low. So in terms of plotting the lows alone, the momentum rate has flattened to the downside. Now, it's not to say there isn't potential FUD that could come out on Binance, Department of Justice, the FTX knock-on effects that we seem to have had a cessation of contagion on, but I'm not sure everything that's come out has come out for various hedge funds and other knock-on effects of the multi-billions that they stole and defrauded. But nonetheless, this is a marginally lower low. There is a cluster of targets here and here. Particularly, I'm referring to the 13,950, which is 14k, and the 15.1, which is 15k. 14 and 15 quite low, not yet run. Again, could these still be run? It's possible, and that's got more to do, I think, with macro events than specifics to do with FTX, Binance, and others. But those are nonetheless possible. Still fresh FUDs. And I say fresh because they're pretty stale in honest truth now, but they've been parked up. We're not hearing so much noise on that, and we're being allowed at a rally. Maybe they re-emerge, refreshened up with a new spin and a new narrative, which would be a crypto-specific event, or we have the macro event. All those other things aside, actually there looks like a sense of general slowing down of the bearishness and potential recovery. This has returned to a similar level. This has returned to a similar level from its last sell-off. That in of itself is bullish. So in essence, you already have a structure now where that represents a left shoulder. You have a substantial head and even an easing off now and a weak weekend could do nothing worse than just set up a right shoulder potentially, even if it's sold off. So that would be a right shoulder. You could be looking at a head there, and you could have a left shoulder. Now, what does that mean, and what could it precipitate for the upside on Bitcoin? So we're talking God market first. Bitcoin, Bitcoin, Bitcoin. All hail. So when we go into that, now, as I've said many times, do not a believer be. It is my overall suspicion that there are all sorts of aspects that you and I are unlikely to know about surrounding the crypto universe. The notion that they will let you have your own money, where you will transact far more efficiently than through their archaic old banking system where they rentier extract on great levels. I've done an international transfer and I'm still shocked. You know, it's $85, 60 for that, 20 for that, yada yada yada. Before you know it, just to send international money from an account. This is such an extraction mechanism, and they live off that. And they keep you running on a treadmill because of these inefficiencies and costs. I know many of you think Brave New World, it's going to be exciting and all of that, but you should have a little bit more superstition around why people are going to allow one monopoly to end if they're not already creating the next one. Anyway, so back to the colors here. So what does this typically mean in terms of a possibility? Well, it means, first of all, let's just change it to soft gray there. And if we clone it, I'm also going to just take it off log scale first before I clone, get it right. Do it again. Okay, so let's drop down into that lower time frame. I'm going to be coming back up when we do cross Bitcoin assessments. So in this video, you're not only going to see an analysis of Bitcoin USD, you're going to see an analysis of Bitcoin versus gold, Bitcoin versus the IXIC, yep, the NASDAQ. So we'll be handling digital gold alleged, digital scarcity alleged versus the real thing of gold, and we'll be looking at digital gold, or Bitcoin as it's commonly known, versus the tech, which it's been proxyized as a hive mind of technology, but a high beta thereof. So let's have a little look first on this lower time frame, jumping on down to the 4 hourly. We capture possibly a bit far. Let's go back up to the 8. We capture this point here. Now, it's very interesting to note, because when it started to go up, we felt that it would meet roughly the cusp of the other side of the cup, if you like. And I was a little cautious of this grind for people to chase in that weren't already in. We don't like that. And then you got a little bit of an event. Oh, the not so soft landing. We'll be coming back to that. Follow the market sniper on the traditional markets with regards debt, everything that goes down in there. So having a look at this, that would have been our expectation for that to be broken to the downside, but it didn't go too far. But you can still do the handle, the right shoulder for this structure. Let's assess where that target would put you on in the event it breaks and meets to the upside. So the interesting thing now is we're in this dichotomy, or this either way option, this divergence of possibilities. Lots of old set up a long time ago, now relatively speaking for Bitcoin years, downside targets with some shorter time frame, it must be said. So bigger time frames are more reliable, but eventually some of them get met, some of them don't get met, but possibly, and then the shorter time frames are met, and they build and they build, and then you end up in a rally situation, and you're back deep in the heart of a bull market. So this would point to $26,000. So if you dip, get a right shoulder, where would we expect? Oh, a nice little run sub 20. 20 is a round number. A little dip through the 20 to that blue line would be more than fine. It would still be higher bottom than the low of this dip. So once again, let me just draw in fat Koki for absolute obvious reasons so that there's no doubt how we are talking. A dip to the 19 would be quite a nice shallow, and there's plenty of scope for it to go lower. The low here is, wait for it, in and around 18,161. So that would be a 19.8. So 18,161. Put ourselves a little reminder on that one, shall we? A tiny line. Do it in blue and dotted 4. And we can take it off at a later point. So that's the low of the left shoulder. Typically we like a right shoulder to not go as low, but it's not a golden rule. It can meet and even in certain extensions exceed, and you still get performance, but you're more likely to get what you want if you are showing more general bullishness, including on the down legs. So a run of the 20k to get into the 19 somewhere would be more than fine for that neckline, which we've got in and around, we've not got it so accurately. I think we want a key level there. We take the logical round number of 21k. So that'll change it slightly. I might adjust it slightly. Bring us a teeny whipper down. May look nitpicky, but you know, we like to practice good. You become that which you practice. Practice accuracy. And key levels of significance are exactly that. Let's also, not quite on the line there, through the middle. There we go. So 26.5 makes sense to me. Just run. Remember the scope for it to be passed through before maybe the next rest and pullback. That would then start to be, if this were to occur, this would put in a series of higher highs over lows. So slowly we go back up the time frames. That would bring you back up to roughly the lows that were encountered here on this continuation. It was quite a short continuation, and then things caught up with everything. I'm not sure if that was the Celsius and that this was the FTX. It's starting to be so many periods of craziness and potential FUD, but you let go of the 26 there after letting go of the 30k, 32 odd k lows there at the 39.40. So these were very successful shorts, but now that last sell-off didn't really take you too much further, and you've taken it all back, which can be the beginning of bottoming. We will get to the but. So let's also do relative value assessment. Relative value assessment. So some of you become aware, even if you're generally crypto specific only, you would have become aware that the stock market didn't have such a great year last year as well, particularly growth stocks. That's right, growth stocks. So what are we going to do now? We're going to take you back into log scale and talk about Bitcoin against the NASDAQ. Bitcoin against the NASDAQ, the IXIC. So now we're measuring at something that has been weaker than the dollar. Weaker than the dollar. And as a result, it's quite an interesting find. So we have actually made our second interim on the first cup gold nugget, which is again this big structure. This is why we have to revisit history, because it's still affecting your todays, my good friend. That was your break in the end. And as a result, there's still plenty of time for this to make its target. In other words, these values will mean nothing to you, but it's essentially what valuation per Bitcoin to a NASDAQ basket. And as it's been pulling back since the 64 highs. So this was, many people talk to me about divergence is so useful with indicators. Not indicators, but this was a divergence in relative valuation. The high was the 64k dollar high. That was where the real momentum was. On a lot of things, we already then started to have the dollar turning, and there was a lot of retail dumb money that got involved for the 69 push. You can see that they were already going more into the tech equities than they were going into Bitcoin. So there was already a backing off. Remember, crypto and Bitcoin is a higher risk, higher beta version. This is how people are seeing it. It's not my choice of framing. It is how it was being characterized. Then owning tech stocks, Amazon and Apple, etc., etc. So that was a failure to make a new high for Bitcoin against tech stocks. That was already a foreboding warning as you started to turn down here. However, cutting to the chase of where we are now, which is more interesting to many of you, again, you have necklines of those two head and shoulders. I've not drawn the targets down there, we can do that. And you have this, so let's clean the face a little bit up here and we can change color just to rinse the mind a bit. We have a falling wedge structure. Our long-term expectation is the red line that I've now doubled up with a blue line to doubly confuse you, is in fact the level that we expect to have broken in the end. That will see Bitcoin as a token starting to outperform NASDAQ stocks on the upside, or possibly in the event that we are having an equity market crash and correction, specifically on growth, Bitcoin going less down. You have to bear both in mind. So we've just had the gold silver ratio and I expected it to go up for a right shoulder. That could have been on gold and silver both going down and gold at a lesser rate, which is typical. Silver is the higher beta. But what actually ended up happening is central banks, they both, silver kind of held its own, didn't go any higher, and gold has been pushed higher on central bank buying. So that was a bullish scenario where the gold silver ratio went higher. So you could have both a bullish scenario and you can also have that bearish scenario where you are going less down in a contractory environment. And we will talk about that when we talk about the macro. But what you can see from this is that that was actually the worst point for Bitcoin relative to the tech stocks. Subsequently, tech had a strong re-rating to the downside during that period, and Bitcoin's relative performance actually saw it going down in dollar terms, but actually dribbling up in a low volatility way. Now, previously, when it had flags, it spilled to the downside, down, and then rising wedge. It even had a little pop out the top, down. This time, out of this channel, it broke to the upside. This is an important shoe to drop, because what this is actually happening is Bitcoin is not underperforming and is in fact overperforming, even though it's not going up that much. It's gone up from around 15K to 21. It is overperforming tech stocks quite substantially. This is a log scale, remember, so the level you're at 31.5, you're actually got on at around 37. That's quite a reasonable move. So the log scale hides this sometimes when you're looking at it. Okay, let's drop into that falling wedge and talk a little more. So normally we look for three distinct impulses inside of the falling wedge. So we would look to see at least this line engaged over here, because in actual fact, the only two meaningful touches came on the 69 high and on the way down. However, there were multiple events inside of that, there and there. So you can argue there were 2 or 4, depending on whether you're looking at the smaller impulses of the zig and the zag there, and the zig and the zag there. That is moot point, but it would be good for another impulse apart from our number 2 impulse here, which is often the biggest and bloatiest inside of our 3 impulse falling wedge. That is a short, sharp and highly church steeple, which highlights the volatility, strong up, strong down. First impulse. So now we're looking for number 3. Ideally, we would want to see something, and I would prefer if we actually had a relative underperformance spell back down and then based. I don't know if we will get that. We could continue to go up. We could have a half pullback You could get a fractal, a smaller little continuation like that. There are lots of ways. There's many ways to skin the cat for how you could break out. There are also the possibility, and this won't be popular for crypto folks to listen to, but it's a possibility. And I'm trying to define the entire fold, the kraal of all possibilities of what animal it is. Is it a sheep? Is it a cow? We throw in a fence and trying to capture the 100%, where you have all probabilities inside the boundary, and then you can ascertain and attach likelihoods to each one of the animals in there. Which one will you be? And one of the possibilities that has to be considered is in the weak macro environment that I'm going to continue to refer to in the latter half of this video. You could have a final sell-off that could actually push you through the low and bring you your third impulse, or at least bring you to it and bounce. So those are both quite aggressive sell-off moments where you either match or surpass the low, and you could have on one of them a dip through the basing descending grind line, that is the lower line of the wedge. Okay, so those are still possibilities. They're not looking likely to you right now, but if we have a very, very difficult late half of Q1 into Q2, where there is substantial issues with banks, repos, don't forget, and I'll get into the macro in a bit, but macro driven, I think, and or small possibility fresh FUD on crypto. But I think that will be more likely to be the macro in terms of my guess, because there are so many reasons as to why we could have a macro downside. So that's Bitcoin against the NASDAQ. Encouraging movement. It has not yet met the other end of the cup that was pre the downside. In terms of NASDAQ equities, it would be good for it to do so. So to make the 38, I think that would also bring you into contact, which again would be a separate impulse now making an interaction with our capping level, would validate our draw on the falling wedge that we've had for an extended period, waiting here to see how it goes down. Remember, big ass chart, 3 daily. I'm doing a half week here on that. So we've also spoken about dominance, and it would be wrong not to refer back to it. And we highlighted many times that the 40% seemed to be the floor on the dominance, and that more recently you had a 41%, my apologies, a 42% interim high. You pulled back once here. I haven't circled it, but we can do, although it already seems like it might have been negated. So the 42 seemed to be a low ceiling, where you had a more strong, beefy 47.5 on the earlier stages, where we were in very volatile periods, as a relative ceiling there. You can see the repeated moves to approximates. It took a couple of wind-up goes this time, and you're just about again number 1, 2, 3, 4, 5 attempts. However, that ended June 22, and we have not got that high again. But the 42 was broken. We said it's quite likely that you'll pull back down, and at that point it's either a 40 that it was going to go to, or the 41, which was a half mark. You have a neckline there. We've dropped onto lower time frames and studied this. This was again also a reversal. This also was a little bit of a shoulder W on the big time frame, and 41. So we can drop down and look at those little patterns. Don't really want to do too much of a deep dive, but that 41 was also a key level. It's also a round number, 40, 41, 42. It's okay. So you would either go down there. In the end, you didn't make the 42, which was going to support the FBTC trade a little bit more had Bitcoin continued to come down. What actually happened is dominance escalated, which gave a pushback on the FBTC trade, even though the FBTC trade still is potentially valid. There was a rather schizo wick though on a number of the exchanges. So if you're in those, that could have invalidated. But what we've now seen is that Bitcoin is dominating again. So what does that mean? If we continue to do the Bitcoin dominance deep dive and we get out of the 3-day and we pop down to the daily, there can be a case made that you've had a little bit of an asymmetric W all the way up to here. Again, where the 42 is your crucial level. This isn't the same depth low as that. So to call it a clean double bottom is not really correct. These two were a double bottom, and that did give you the target back up to here, and that's already transpired. So once again, it affirmed the 42 is a key level. You came back down to that neckline, the 41. There's a technical run always just through it, but that's the point of support, and now you are up. So for that reason, we speculated on this larger W bottom, which is slightly asymmetric, it has to be said, and said, where could Bitcoin dominance go from here? It feels like a long time that you've had a Bitcoin dominance bull run, honey badger, hoovering everything up, and I think many people miss that. And that's around 45%. No surprises if you're coming from around 38 to 42, 38 and a half. You're getting 1.5 and 2, you're getting around 3.5, and you're at 42 and you're getting around 45.5. So natural geometry dictates that a 45.5 would be a good performance from Bitcoin, likely in a pretty bullish environment. All this in the environment where things stay roughly as they are. That is not typical, however, of dynamic systems, and there's a lot going on in that big bad external macro world. Again, I'll refer to that in a second, but let's finish on the Bitcoin analysis first. So Bitcoin versus gold. Let's bring her up. I also like to highlight that it's never a bad idea, especially where the dollar has become a large part of the story, also occasionally to just have a look at some of the other crosses. Bitcoin Euro. So on Bitcoin Euro, it will show you in perspective that you have not reached this cusp of the cup, and might just take some of that excessive bullishness out of your sales, which is invariably a good thing. Even on the Bitcoin pound, your pause has not come at the cup. You've yet to make a new high. So some of this has been function of a very weak dollar. Since our 111 Dixie target run, you had a spike off to 14. Lots of people started calling 120, 150, and of course, absolute slam down to 102. On the yen, USD yen, the Euro USD has gone to 108 after below parity run. Complete pullback. Targets are targets for a reason. You take profits. You don't sit and wear the bag of puke all the way in your pocket down the elevator. It stinks up the place. You don't have to hold it. Anyway, so that's it. And even on the yen, you'll see that it is yet to reach the cusp of the shoulder. So do not get excessively bullish on the fact that against the dollar, it's reached the old cusp, because a large part of that has now been introduced by the dollar narrative. Again, another reason why to look at crosses. I'll even throw in the Aussie for our Australian fans and friends. Hit the like button if you're Australian, New Zealand, or any other country. Did you see what I did there? That was a dirty trick. Anyway, so we move on. So Bitcoin to gold. Let's bring her up. So I'm going to run with Stamp, which is biggest history. Again, you'll see the wedge draw over here. What I'm aiming to do is to do divided by gold futures, and we want the COMEX, not the Indian. And it's amazing how often the Mumbai exchange seems to jump ahead of the COMEX, possibly because there's probably more actual trade going on there than anywhere else, and certainly than in the States. Okay, so Bitcoin versus gold. Now, again, the whole history story is this we were looking at this low volatility period and saying, could there be another move to the upside for the Bitcoin versus gold? What you can see against gold, with it being 11 ounces of gold secures you 1 Bitcoin, it's still not returned to the 12.5 and 13 ounces of the previous low at that point over there. Again, you know the first cup gold nuggets, all the aspects surrounding this that we've drawn, and can I point out that this is probably the most seminal case for HVF method you can ever hope to see. I mean, if you realize that gold is it and is the alternative that Michael Saylor spends most of his time trying to debunk, and put forward his digital scarcity, which could be voted out or hacked, versus the immense difficulty of having to mine it out the ground, you will see that this was an unbelievable gold ounces call for top. 34 gold ounces call from breaking right down here. The stop was at 5 and the entries at 6, right the way to 34. So you're talking almost by 6 times from the average. If we take our midpoint area there, which was in and around 5.69, and you multiply it by 6, you're getting around 34 ounces. That's an unbelievable top call, and you can see how marginally similar these highs were, slightly higher on this one. So Bitcoin against gold. Let's drop down into that and have a little closer look. We're going to drop time frame quite some bit because I want to bring it into this interesting little breakdown. So let's go to the daily. So it's quite important what the difference between the highs are here. 1307, 1305. So that is a valid structure as we drew it. That part is slightly higher. So there was a sell-off that has occurred, but there's also the potential for a downside target unfulfilled on the gold as well. So here's what crypto people really need to understand. It's quite possible that we get rallies, and the downside, it's a very dangerous market when you aren't predominantly trending. And so for the bears, you can get killed because you're going to have pumps like this. And for the bulls, you can also get killed because it can go your way for a bit and then you get a sudden slam. That is outside of crypto's even sphere of influence and control. So these are the interim phases. It's not a case of binary. You go from absolute bear to clear-cut bull. There is often a transition period in the middle. And sometimes the prudent wait for the gift. And a second knockdown would probably be close to one of the last if Bitcoin and crypto is surviving as we expect it to. So let's have a look at this. Let's go just with 3-day first. Do you have the same draws potential of wedges? Yes, on just about all of these you do. In other words, this has been a squeezing. That is encouraging. In fact, I'm going to pull this a little harsher and see if we can draw it as a falling wedge that's already broken. So there you go, you can see that line. I'm going to reduce the dominance of those lines just so that they're less aggressive. You could arguably, in the Bitcoin versus gold case, already be nosy, tweaky, tiny bit through the capping descending grind line of the wedge that we draw here. In terms of the basing descending grind line, if that is our low, I think we need this to run a little flatter like that. That would probably be how I would characterize this draw. By the way, that target was made on BTC Gold. That was the head and shoulder for what we called the blue head and shoulder. Remember how well this target performed. Look at your exit there on the first cup gold nugget. Flag there. Neckline, break, key target make. Splitting our wedge, we can see to what degree the half moves, half of channel have occurred. A resistance there, it captures that shoulder well and the peak pretty well. So I'm happy with that as a falling wedge draw. And there is a possibility versus gold. In spite, remember, gold has performed well. Gold is at around about 1929 recently. So we're talking the last few weeks, December, January. It's performed well. It's remained above 1900. But due to the steepness of gradient of that capping descending grind line, that I've elected to draw, we have actually got a break. So you have a falling wedge. News alert, falling wedge break for Bitcoin against gold. And that's a strong performer. Steeper wedge though, this, as I've said, this line is coming down hard and fast. But gold was performing pretty poorly in this early stages as well. It's also getting slapped around with the dollar strength. Not as much as Bitcoin, but with the dollar strength, it was being slapped about. Okay, so that's quite interesting news and an interesting news flash for everybody. What happens with falling wedges after a break? Well, you can sometimes retreat back in before moving forwards. It's called the return move. So progress for Bitcoin. What was the lows here? I think you're around there, and I think it's about 8.7. However, macro goes wrong, keeping your brain attuned to all the possibilities, and that's the danger and the trouble with this. There's too many variables at the moment, and the macro is a big variable. Macro goes wrong, you can spill both to the previous low and double bottom and trade sideways out and then go up, or you could have an absolute thriller, a spiller all the way from Manila that could run you to a funnel check or even a funnel break if we have a big enough shock to the downside, and that causes problems again for crypto. So during this period, we have to bear in mind that Bitcoin did underperform gold from that point on in the same way as tech stocks. So crypto's had a tough time. As a high beta tech area, it's had a tough time. Okay, so let's talk about some of those macros then. Let's talk about some of those macros. What are we discussing? Your good old consumer. So since the 2011, well, this is March 2020. Let's cover this. Your savings rate went up with the furlough. So that's this green line over here. Now drawn in pink to confuse you. Sorry about that. Let's do it again. So the savings rate, it is undeniably a corollary to your credit card rate, your credit spending, credit lending, and credit card debt, the red line. Pivoting to the red line and using pink. At the same time as lots of people were saving, they didn't need to spend as much on credit cards. As saving has gone down, the credit card spending has gone up. The other key point with credit card spending, now at 19% average interest rates of payment. So at the subprime lows of 2014, you were sub 12%. The pandemic levels, the needlecraft era, 2021, which is where we are here, needlecrafty, you're at 14.5. So now add another 5% on 14.5. So you've got more debt because everybody is spending more on essentials with credit cards, and the rate at which they're having to pay on that debt has gone up 25% since the lows of needlecraft, and closer to 40% from, you know, sub 12, going, no, almost double, about 80% to get to 19, from 11s and 12s, so 70% odd. So this is a terrible consumer event. So you're going to have a consumer related economic recession for one. That's for one. The allowances that companies like Discover have to make for bad debts is going to spoil their books as well. So you don't have a consumer recession without financials getting hit as well. Financials getting hit, consumers getting hit. Then you pivot to housing market. Don't forget, everyone's been still squeezed by the inflationary changes. The rate of change in inflation is still high. It's just not as high as it was. And you are comparing month to month. So you're comparing this month to a higher inflation month the longer you go in. You're not comparing it, you don't have base effects, which is comparing it to a long ago low level of inflation as you moved into a higher era. So you're not killing inflation, you're just the rate at which you're going up relative to the same month last year is going down because that was a much higher base that you're now comparing it. So it's entrenched and it's still with you. Those prices aren't going down. The rate at which they're going up are slowing somewhat compared to a higher month than you compared to before. Did that make sense? If it did, you're kind of smart. Okay. So that's what's going on. Financial sector, consumer, wrecked. Okay, so let's go to the housing markets, and this headline says it all. Current housing bubble, 2008, makes it look quaint. In short, in terms of the extremity of pricing relative to disposable incomes, you can see what happened in 2007 when you dip there. This is the massive gradient. Median average US home prices absolutely rocketing after 2020. Don't forget they dumped 6 or 7 trillion, no one truly knows, and furloughs and a whole bunch of other things into the realm of the world, and it chased asset prices. That's right, and everybody bought a house and they borrowed cheap money to do it. Now the money ain't so cheap. Now their discount rate is coming up, and you've now had the Fed do 4 0.75% increases. This is macro. This is what you often don't want to hear when you crypto guys, but the guys are getting killed. So you've got housing, which is a major driver of wealth effect. You have consumer being hit. What you're probably seeing in Bitcoin is an end of the selling for now. And given small volumes, this is where volume analysis now comes into the play. On small volumes, you are now seeing the market go up on account of seller exhaustion. Anyone who wants to sell has sold. All the panic sellers are now panic sold out. All the reasons, all the terrible news, FTX, the wallet hodlers of Bitcoin are still wallet hodlers of Bitcoin. And if they bought it 3 years ago, they're still holding it. The traders are wrecked, removed, and have no more money to buy or sell. So it's now a function of, on very light volume, this market can move up. However, if we ever dislodge into poverty those hodlers, that they become forced sellers, there is scope for another sell-off. That's not a prediction. I'm just saying, if you get a really grim recession and it's a question of feed the family, pay the rent, especially if you're not a serial offender category, you're typically have always done that, and you have Bitcoin you have to sell, then you will sell it. Liquidity is chased as the first order. People start selling couches and furniture and other things for rock bottom prices only very late on, because it's not a liquid function and it doesn't store value well. Bitcoin is a better one for that in the events of the macro non-soft landing scenario that we are calling. We don't know how bad it could get. We don't know how far it could go. And we don't know which asset classes will do relative well. By the way, so as someone who's supportive for precious metals, if Bitcoin is sold off, gold and paper gold price and paper silver price will go down too. So I'm not fanboying gold and punishing Bitcoin. They will both be sold off. Liquidity assets that hold value will be sold off first. And this is your threat with this. But in the meantime, you might have to sit in your hands if you were in fear of that and watch something like this go back up to 26K. And maybe even after that sell-off, it only comes down back to these levels before going back up again. In which case, engaging here and not being a forced seller, hopefully down there when the SHTF hits the fan, you've done quite well. So I can't tell you how far you go up first and how hard you might get hit down. You might go that far up, but the down could be so ugly, it takes you to a worse level. And you run all those outstanding targets and even support in the funnel. Remember the COVID, and then you go strongly up post QE and it's going up like that. The probability, however, is that level of volatility will flush many people that haven't been flushed out as forced sellers. That's your challenge. How do I stay in the game? That's what we specialize in. Remember, making money in reset times. www.themarketsniper.com. I am Francis. I have given you a couple of scenarios why you have downside risks outside of the crypto, everyday crypto FUD, Tether, Binance, Department of Justice, why you have outlier risks that will hit both gold and other asset prices down, along with housing, in a great disinflationary stroke deflationary contraction, which will be the death of money. And a lot of money will be sucked out of the system. What will the Fed do? February, they have a rate decision to make. Will it be 0.5? Will it be 0.25? Will there be no rate decision? It will depend. But whatever they do, they are damned. If they are soft, the dollar will continue to fall. That will, all the inflation they exported to the UK and Europe by keeping the dollar strong relative to the pound, and thereby seeing the pound sell off, the euro sell off relative to the dollar, and getting more inflation in the United Kingdom and the Euroland and other parts of the world. If they don't do the rates hike, and now they're not meeting markets' expectations for rate hikes, what they will then do is they will let the dollar slip, and they will lose bids for their treasury markets, and people will start flooding back into treasury markets of the British and the Eurozone, in spite of the absence of bid in Britain, because it's the difference of expectation in interest rate hikes that America will make relative to the other nations that sees money flow into dollars buying the safe haven of debt, safe haven inverted commas. If you do not keep the interest rates hikes coming, you will see a loss of power in the dollar continue to the downside. How much that is being priced in already, and people are already saying they can't do the 0.5, they might do 0.25. We don't know. It will depend. But some of it might already be priced in. The market is guessing all the time. But I think they're going to err to the side of hawkishness. If they do 0.5 and they try to keep some heat in the dollar and they're not comfortable with the dollar slipping too much further, what that could do then is create further damage to the consumers. Remember, another 0.5 on top of your home loans, on top of credit cards. That's going to see the credit rates, more defaults, more damage, more Cathy Wood. You're killing the market. And so they go on. I think they have a license to kill. And that is to really, really crush the consumers and flush people out of assets at the bottom of the curve. So I think they're going to bias to hawkishness on the basis that if they don't, the dollar gets murdered. There are a lot of threats to the dollar from the BRIC nations and the other nations coming in right now. As a result, they have to keep half an eye on that, which means they have to bias hawk and rather be too slow to take off the pressure given that they were already very late to turn up the heat. Okay, what do you think? I want to know what you think. What is the Fed going to do? Is it half a point? Is it 0.25? If that happens, will Bitcoin get a rally like my pink scenario and then a minor pullback or a reasonable pullback but not a new low? Are we on a series of higher highs and higher lows for Bitcoin? And whilst you type up your answer as to whether we're on a series of higher highs and higher lows for Bitcoin, let me leave you with a little epilogue on the inversion of the yield curve. Yes, indeed. Spoke earlier about this with Mario. So for those, some of you will know that I've been deeply concerned about yield curve inversion and the extent of it that happens. Broadly, to many, the subprime crisis was the largest crisis compared to, say, the dot-com. But as you've noticed, the sensitivity is getting tighter. So smaller dips are leading to bigger crises. Most of us would argue this was the biggest crisis. And in fact, the CV19 crisis only put in, the needle crafty only put that much. And it was September, October on the repo rate dramas. And that was what then occurred as a result, which was huge and was probably even more broad scale and damaging than subprime, which of itself was probably more for the retail man, certainly, than dot-com, which was probably more than long-term capital. So you can see these have been getting bigger in scale, but they've been smaller by yield curve inversion. So the current person who's made all the academic that was behind the yield curve inversion indicator as a leading indicator. At HVF Method, we are interested in leading indicators, not lagging indicators, things that give you advance heads up when things go wrong. This first collapse here was already 2006. And in fact, the Lehman's event is occurring in this move up. That is when you find out the event. In the same way, the advance warning was September 2019. The COVID event was March 20. Needle crafty became the game. So there you have it. This is a leading indicator. Your event that will be hitting you, that none of us know, potentially a bank hack, could indeed be only happening to you at this point when you are part the way up and out. As hard and as fast and as deep as you go down, I would assure you that given these levels of sensitivity, the crisis that is coming is indeed very, very potentially brutal. And I would imagine that there is some proportionality to the scale of the inversion that you are seeing currently. So do not underestimate the downside potential of a macro hit coming our way. And that could see the most liquidity items that sell for current immediate dollar term values suddenly be sold off. It could be, in an extreme event, a kicker as well for both gold and silver. But initially, as people respond in fear, they will run to hold cash and physical things. And that is my impression. So watch out. What do you think is going to happen to Bitcoin? Higher highs, higher lows? Will it be hit in a demand destruction event for downside? Should you sit on your hands or should you engage? This is the big question. I hope you found this interesting. That's essentially the facts as I see them for how you should be positioning in terms of crypto. Maybe a little bit. Do not go in all in. I would suggest against that, albeit initially rewarding. Be careful. Be careful. Until next time, don't forget to hit a like, book a call. We're in building wealth in reset times. And this, my friends, is a divining period, a polarizing period where those that have taken smart money management and cautious of volatility and leverage action will do exceedingly well in an environment where many will be getting mashed. Until next time, we catch you later. Bye for now.